What's going on, team, and welcome back to another video. So today I want to teach you about macros. A macro is a 20-minute interval, and it's always going to be the last 10 minutes of your hour and the first 10 minutes of your hour. So as you can see, we have 9:50 marked out because it's the last 10 minutes of the 9 o'clock candle, and we also have 10:10 a.m. marked out because it's the first 10 minutes of the 10 o'clock candle. So that 20-minute interval here is known as a macro interval. So why is this 20-minute interval so important in the markets? Whenever we're trading within a macro, the algorithm is always going to seek a liquidity level or an inefficiency in the market. So this can be buy side and sell side liquidity or fair value gaps within the market. Every hour has a macro interval, but the lunchtime macro is the only one that you should avoid trading. Because there is a lack of liquidity during the lunch hour, which is normally 12 to 1 p.m., we actually recommend trading any macro outside of this hour. So this can be the AM session or the PM session after lunch. When exactly do we use these macros? Well, we use them every day, but the best times to use them is when there's no impactful news on the day. And this can be a red folder economic report or high impact earnings. So on days when there's no news and the market is slow and choppy, that's exactly when you should be trading these macro intervals. So now I want to show you two examples using the macro intervals. Our first example happened within the 9:50 to 10:10 macro. You can see once when the 9:50 candle opened, price immediately wanted to see lower to fill this inefficiency. And this inefficiency here was actually a gap that was created at yesterday's open. Once the futures markets open, you can see that this gap was created here and we eventually tapped into it within the macro interval. Before I show you the second example, I want you to study the price action in between these two macros. You can see right after the first macro ended, price slowed down and wasn't really seeing higher or lower. But the moment we entered into this macro, price immediately saw lower. And this is because the algorithm was seeking the sell side liquidity that was resting below this swing low here. So even though the market was slow and choppy over here, you can see that the moment we entered this macro, the algorithm wanted to seek the sell side liquidity. So now that you understand what macros are and how they work, here's something for your notes. Macro timeframes will not work if you don't have a narrative in place. What do I mean by this? Well, if we're expecting the macro timeframe to draw lower or seek a sell side liquidity level, we have to have a bearish narrative on the day. This means having a bearish daily bias and also having bearish market structure that can back up this narrative. The only reason why these macro intervals played out was because we had a bearish daily bias and there was bearish market structure. You can see that the market swept above London highs, which was a major buy side liquidity level, followed by a market structure shift for lower. And on top of that, we had a major gap to the downside that was created from the 6 p.m. open. So seeing all this, I knew that markets wanted lower, hence why the macros also respected price for lower. And with that being said, team, if you have any further questions on this video, please reach out to us through our questions channel located in the Discord server.